If you travel to Leh, Ladakh, high up in the Himalayas, you expect to find snow-clad peaks, thin air, and rugged terrain. You do not expect to find a physical branch for a mutual fund company. But last year, one of India's largest asset management firms set up shop right there. This physical foothold at such a high altitude marks a milestone in the movement of financial assets into the country's most remote regions. Historically, households in these regions stored their wealth where they could see it and touch it. Savings meant land parcels, real estate, and the security of physical gold. The stock market was viewed as an exclusive playground for the urban elite in places like Mumbai or Delhi, largely inaccessible to those living in the hinterlands. Today, the geography of where you live no longer dictates what you can do with your money. The barrier between small-town savings and the national stock market has begun to dissolve. In financial terms, locations beyond the top 30 cities are classified as B30, and right now, these towns are the primary engine behind the surge in retail investing. This chart shows mutual fund distribution across the country. B30 locations now account for 27.6% of the total. This segment is growing faster than major urban centers. For monthly systematic investment plans, or SIPs, new registrations from smaller towns now exceed the top 30 cities. The data reflects a change in how people manage their money. Families are moving away from episodic lump sum hoarding and adopting the habit of disciplined, recurring financial investments. Small towns have transitioned from being spectators to the primary driver of new retail participation in the Indian market. For decades, the barrier to investing in small towns wasn't a lack of capital, it was a lack of physical banking infrastructure that made transacting nearly impossible. As smartphones became common, vernacular fintech apps expanded into the rural void, bringing the stock market directly into the hands of millions. The rollout of Aadhaar allowed for instant digital identity verification. What once required stacks of paperwork and multiple branch visits can now be completed in minutes on a mobile phone. As the technical barriers fell, so did the financial ones. Zero brokerage models and micro SIPs, which allow for investments as small as 100 rupees, made it mathematically viable for entry-level investors to join. Technology bypassed the need for traditional brick-and-mortar buildings, turning a standard smartphone into a fully functioning bank branch for those who were once excluded. Because these investors often come from backgrounds where income can be erratic, you might expect them to choose only the safest, lowest-yield financial products. The data shows the opposite. This chart compares how different regions allocate their assets. Look at the B30 column. Over 64% of all assets are held in equity schemes, funds tied directly to the stock market. This cohort is choosing growth over the complex hybrid strategies favored in the cities. This 64.3% concentration shows a relationship with risk that is focused on specific financial goals. These investors accept market swings because they are looking for the wealth creation power of long-term equity. They are often following the lead of early adopters in places like Gujarat or Ladakh. People who started with monthly contributions of just 2,000 rupees in the year 2000 and maintained their discipline through market cycles now hold multi-crore portfolios. When provided with the tools, small-town investors are proving they will choose the growth of the market over the familiarity of traditional assets. However, this rapid expansion has created a paradox. While a digital account provides access, it doesn't automatically teach the behavior required for successful investing. The speed of this technology has created an advice vacuum. Millions of people are entering the market for the first time without the help of trusted local advisors or a clear understanding of financial literacy. In this void, social media influencers have gained massive followings by pushing return-centric narratives. They often focus on recent performance snapshots while ignoring the importance of asset allocation or the risks involved. This line graph shows the consequences. Sales of highly speculative thematic funds to B30 investors spiked by 128% in a single year, suggesting that many are chasing trends rather than building diversified portfolios. Opening the gates to the market without providing the wisdom to navigate it has left many of these new investors vulnerable to significant losses. The fallout is already appearing in the data. As markets undergo corrections, SIP cancellations in B30 regions are rising sharply as inexperienced investors who were promised quick gains begin to panic. The mutual fund industry is now shifting its focus. Instead of just acquiring new users, firms are deploying more registered human intermediaries into small towns to build the trust that digital apps cannot provide on their own. There is an urgent need to teach asset allocation, moving some of these concentrated holdings into debt and fixed income products to cushion the impact of market volatility. Fintech platforms are also being encouraged to recalibrate, designing interfaces that simplify complex choices and reward long-term thinking rather than impulsive trading. Building the digital infrastructure to reach small-town India was a significant feat of engineering, but the stability of the nation's financial future now rests on a more difficult task: teaching these millions of new investors how to navigate it safely.